Well, let's get to what's going on in the US at the moment. Welcome back to the show, Larry Shover from D. Alexander, live by Skype from Chicago. Larry, great to go and see you there. Want to go and talk
Thank
central
you.
banks. We know that central banks have been a big part of what we've seen over the past 22 months or so. It's going to be an even bigger part in 2022. What are your expectations for where the Fed is at the moment?
Well, yeah, you're right. 2022 is going to bring in a lot of central bank divergence. I mean, with regards to the surprise we saw from the Bank of Canada, RBA, like really nobody knows what's going to happen next year. The Fed's going to hike as early as June of 2022, or at least that's priced into the market. And the ECB seems to be well behind the curve. So policy divergence and asset divergence is apparent right now, at least if you look at the interest rate curves around the globe.
The Fed, how far behind the curve is it, in your opinion? Because we've got inflation running extremely hot. We've still got quantitative easing going on, albeit at a slower pace. What are your expectations for early 22 next year? Because the Fed seems like it's going to have to go and play catch up a little bit here.
Yeah, I mean, it's a great question. I think that's the billion-dollar question is like, is the Fed behind the curve? Are they on the cusp of a policy error? But when you look at break evens, the way they traded today, even like the 5-year tips auction, it's telling me that perhaps this is all plateaued and maybe the Fed's doing a decent job. I mean, they don't have a great track record as being an inflation fighter. I don't think no one is, but at this point, it seems like it's plateaued and priced in for a June hike if the inputs and inflation stay at bay as they are right now.
Financial conditions are still very, very accommodative. I think everyone can agree on that one. Quantitative tightening has been one thing that's been brought up and talked about because we've seen the Fed's balance sheet has increased by trillions over this pandemic period. Now, maybe potentially selling some of those back might go and tighten conditions to go and try and rein in those inflationary pressures. Where do you stand when it comes to the likelihood that we'll see QT next year?
Yeah, so it's like I think it all has to do with the pandemic and the progress out of it. Omicron definitely was a big fear, and we can see like now the fears have kind of come down a little bit. More about the Fed being very data dependent as they have been in previous hikes in 2015 and 18. We have to keep in mind that the economy here in the U.S. is in a lot more solid footing than it was a year ago. We've added 6 million jobs. I mean, we still have problems with the participation rate, but the market seems to think that combined with the fact that inflation perhaps plateaued has been the thing for the market right now and why we've seen the rally that we saw today, at least in the equity market.
Yeah, the 2's 10 curve, the 530s, the 1030s are all flattening out at the moment. So what do you make about the signal that's being generated there at this point?
Yeah, I think going forward, the curve will be flatter. You figure if the Fed really is going to hike, if they're really going to continue to taper and then hike in June, the battleground is going to be in the belly of the curve. And to me, that's the 5-year. And I think that we'll see a convergence between the 5 and the 30-year coming together. I see the 530 curve compressing down to at least 30 basis points by the end of 2022, largely because they're going to raise rates. That's going to impact growth and inflation expectations, and we'll see that the long end of the curve kind of fall off, but see the front end really spike.
So where does it go and leave no risk appetite out there? Because as you mentioned, the rally in equity markets today. You've got a flatter curve. Where does that risk start getting priced into the market and riskier assets start to go and incorporate higher rates? Because if you've got risk-free rates for the 10 years sitting at 1.5 or lower, it certainly seems to be very, very accommodative still.
And that's the thing. Still very accommodative and still a lot of tools to employ in case the Fed has to pause. But all that to say, I see the 10s trading near 2% by the end of 2022. I don't think it's going to be a straight line up there because the Fed, even though it's not a mandate of theirs, I think it's an inherent mandate to watch the financial conditions, to watch the volatility of the stock market and the general pricing of the stock market. So if if long rates tend to go up too far too fast and the equity market craters, I think we'll see a Fed pause. But in the meantime, I think the Fed is more than willing to allow rates to drift higher, and hoping they do, longer rates, and the stock market stays in check.
So maybe echoes of 2018, late 2018 in particular, with the Fed and its quantitative tightening program. Look, Larry, just to go finish off, where does that leave the US dollar? The greenback at the moment has had a pretty good year again. What are your expectations? We've got likelihood that we'll see slightly high yields next year. Usually in a tightening cycle, the US dollar is well supported. Is that going to be the case again?
Yeah, so here's the thing about the dollar, at least in my view, is that so much good news is already priced into the dollar, and I still think it does have 3 to 5% room to move on the upside. The Fed is going to be commencing and ending QE well before the Bank of Japan, well before the ECB, looking at a June 22 hike. If energy prices stay elevated, that's definitely going to put downward pressure on the Japanese yen and also Euro FX. And our growth trajectory is just a much higher. So I do think so much perfection is priced in. But the downside of that is if the Fed should pause, if there's opposite to reflationary ambitions, we could see a big correction in the dollar. But all that to say, I think we're going to see a 3 to 5% rise in the first half of 2022.